Today, I'm delighted to introduce Ronan Ryan, who's Chief Strategy Officer at IEX Group. And it's probably worth pointing out just at the beginning that true to form, we are starting 350 microseconds late. Ronan, I think maybe why you have an enormous stature this year.
Physically.
Physically, yeah, you've grown. It's not that he needs no introduction, it's that he needs no introduction by me when he's been introduced by Michael Lewis, who wrote in the New York Times Magazine earlier this year, Ronan Ryan didn't look like a Wall Street trader. Judge for yourselves. He had pale skin and narrow stooped shoulders and the uneasy caution of a man who has survived one potato famine and is expecting another.
Of all the lines you read.
He also lacked the Wall Street trader's ability to seem more important and knowledgeable than he actually was. Yet from the time he first glimpsed a Wall Street trading floor in his early 20s, Ryan badly wanted to work there, apparently. Quote, "It's hard not to get enamored of being one of these Wall Street guys who people are scared of and who make all this money," he says. There's a lot of themes in there. First of all, I wanted to just check to make sure that's accurate. But also, the images we have of Wall Street and what people do on Wall Street have come into focus in a new way, in part because of your work this year. So I think, why don't we start with just reacting to what it's like to be written about, correct anything that needs correcting, and maybe just give us a quick overview of the journey you've been on.
Yeah, no, absolutely, and I appreciate being here. I was talking to Eric 2 days ago, and at the end he's like, how do you feel about talking at a sustainability conference? And I went back to my marketing guy, and I'm like, what the hell am I talking at a sustainability conference for? But as I sit here, and I heard Hendrik before say things like movement, it does have a lot of correlation to what it is that we're doing. So for those of you who have read the book, I really don't say the F word as much as he made me say the F word, but I do curse a lot, so apologies if one slips out. But yeah, to be written about in a book is pretty exciting. We started this campaign about 2 years ago. A bunch of us quit our jobs, and we set out to create a fair stock market, as crazy as that sounds. And we ran into Michael Lewis about a year ago. And he actually wanted to interview me because my background was in trading technology. I left college. I wasn't one of those traders I was enamored with. I ended up being a network engineer in the telecom space. But that morphed into creating low latency networks for high frequency trading. That's a mouthful.
Yeah.
Yeah. So high frequency trading is just trading at high speed. 10 years ago, that was in thousandths of a second. Now it's done in billionths of a second. And high frequency trading is a very, very broad definition, and I'm not here today to tell you that all high frequency is bad, but there are certain strategies in high frequency that front run large institutional orders. So it's not necessarily the retail guy at home buying 20 shares of Apple, but when you invest your money with a 401k and they go out to take a large position in Apple, guess what they're buying? Hundreds of thousands, if not millions of shares. And if someone can sniff out through technology that there's a buyer in the market and buy that stock ahead of them and sell it back to them for more money, that hits all of our pockets. And that's sort of what started us off on this movement. So I'm going around in the answering the question, but...
No, go ahead.
Yeah, so what I'll do is I just want to explain sort of how we came to this. So I built out low latency networks. What that means is a lot of people don't realize there's 12 stock exchanges in the US. You can trade IBM, Facebook on 12 stock exchanges, and everyone just thinks of NYSE and NASDAQ. And those 12 stock exchanges have names like Chicago, Boston, Philly, New York, NASDAQ. All of those 12 stock exchanges are now in New Jersey. And all 12 of them happen to be in 4 buildings in New Jersey. Now, as I started to tell Michael Lewis this when we first met him, he kept saying the word, "That's bizarre." And I kept saying, yeah, it is effing bizarre. And so he asked me to take him out to these data centers. And why are they in 4 buildings in New Jersey? So what happens in the world of trading now, it's all done with technology. There's those guys you see on the floor at the New York Stock Exchange when the market opens. They'll even call themselves, to a certain extent, they're like clapping seals. They're just like this. They're not really trading there. They send those trades and they go out to New Jersey, and they're all traded electronically. And there's a term, and not to get too technical, but it's a really important term to understand as it relates to Wall Street these days. It's called co-location. And what co-location means is all of these exchanges now put their technology in one of these 4 buildings, and they sell space in that same building for you to put your strategy right next to them. Why would they do that? Latency is bad. Finding out latency, a lot of latency is bad for high-frequency trading. They want to find out that information as soon as possible. The biggest cause of latency is, fancy word, but it's easy to understand, it's called propagation delay. Just means the further away from something you are, the longer it takes you to get a signal. You want to get that signal quick? Put your computer in the same room as the matching engine, the exchanges technology that matches buyer and sellers. So colocation is a multi-billion-dollar industry now as it relates to trading. All exchanges, every single one of them, globally virtually, they all offer colocation. And they make a lot of money. Like if you look at the revenues of NYSE and NASDAQ, the two most popular exchanges, single-digit percentages of their revenue actually come from trading. Selling technology to certain constituents is a huge, huge portion of their revenue. So how this came about is I was a technologist, had nothing to do with trading. I don't think I look like a famine survivor. I'm 165 pounds. That's not that skinny. But in any case, I was building out these colocation environments, and I was building out circuits to get that information as fast as possible. The high-frequency community started to approach me in and around 2004 and say, how can I get from point A to point B faster? How can I get closer to the exchange matching engine when I'm in that data center? It's gotten to the point now where it matters where in the room you are. People are measuring the lengths of their cable to get as close as possible to the matching engine. So why am I telling you this? When I came to Wall Street, I still wanted to work on Wall Street, and I was a technologist, and I got a chance to work on a trading floor, and when I walked onto the trading floor, there was like 700 people there. 9:30 when the market opens, everyone starts screaming. I'm like, what the hell am I doing here? And I had network maps out on the table, and the traders started to make fun of me and call me boxes and lines guy because it looks like boxes and lines. But there was a huge frustration on the street, and there still is a frustration. Institutional investors say, hey, I want to buy 10 million shares of IBM. I see 10 million shares of IBM for sale at the price that I want to buy them, but when I hit the button, I get 2 million done, and the other 8 million, in a fraction, like blink of an eye, is offered for now a few pennies more than it was a second ago. And they're like, what the hell is going on? I went to the brokers. Brad, who's the CEO of IEX now, he had the same frustration. He's like, I keep seeing it, and it disappears. The technology guys at the bank, and I'm not here to make fun of them, but they're like, oh, it's just slow market data. That's what's happening. Someone else is getting there ahead of you. It's just a coincidence. So I came on the floor, and I wasn't a smart ass, but I said, listen, watch this. And I'd turn to the tech guy, and I'd say, give me a number between 1 and 10. Everyone always picks 7 for no apparent reason. And I'd say, count to 7. And as they're counting to 7, I'd say, look, here, there's 100,000 shares of IBM for sale at the price we want. And as they're counting, the price might flicker just a little bit. And I say, now are you done? And then I hit the button. Once I hit the button, I'd get maybe 40,000 of the 100,000 I saw. And I'd be like, see, it's not the technology. We are the event. The institutional investor trading on your behalf is the event. It's critical to understand that. So we went on this study. I worked for RBC at the time. RBC is a big bank in Canada, but in the US it's relatively small. And we built out a new platform. And what we did is we were very lucky. They gave us $150 million to put in a risk account, and they said, trade it, but don't lose more than $10,000 a day. It's not as easy as it sounds, guys. So we were trying to buy, and then we'd sell right away. Buy and sell, and we were trying to get everything that we saw. So we call it disappearing liquidity. This is why I told you about colocation. What we found out was 4 buildings in New Jersey. Let's just say there's 100,000 out there for sale. We see it. 25,000 is for sale in one building, 25 in the next building, 25 in the third, 25 in the fourth. What happens is a broker in New York will send out 4 orders to the 4 buildings to lift 25,000 on each. That's how you get the 100,000. What we found is, this was 2009, we were sending out these orders simultaneous, trying to get there as quick as possible, and we would arrive at the first venue, and the time difference between us arriving at all 4 venues was only 2 milliseconds. That means 2 1,000ths of a second. A blink of an eye is 300 milliseconds, so we were hardly slow. However, back when I was in my previous role, and I did not realize I was doing bad stuff, just for the record, I would devise strategies whereby you can catch that signal at the first venue in as little as 476 microseconds. So 2 milliseconds was our variance. Someone could catch it in 476 microseconds, which is a quarter of that interval, see someone trade at the first building, and front run them to the next 3 buildings. So as Star Wars as that sounds, as you're sending 4 orders out, someone catches it and runs to the other venues ahead of you. what we did to prove it, and this is kind of what set off this mission and how we ended up meeting Michael Lewis, is we said, well, if we're arriving at the venues with a 2 millisecond variance, why don't we try and arrive at the venues as near simultaneous as possible? And everyone's like, oh, that's crazy. What are you going to do? And I said, we're going to slow down our fastest circuits and inject latency. So let's just say it took us 1 millisecond to get to the first building, 2 to the second, 3 to the third, and 4 to the fourth. So the long pole in the tent, 4 milliseconds. So to the fastest circuit of 1 millisecond, we just injected 3 milliseconds. Second circuit, we injected 2 milliseconds. Third circuit, we injected 1. So the whole goal, it seemed so counterintuitive at the time. And now people go, oh yeah, that makes sense. But at the time, they're like, you're out of your bloody mind, right? And what we did is we injected latency, send out the orders, and we were able to arrive at these venues as you can never be simultaneous because there's a lot of variance to latency. But instead of 2 milliseconds, we got the variance down to 290 microseconds. So 290 millionths of a second. Some smartass says, well, that's not technically simultaneous. It's simultaneous enough. But in any case, what happened is from that day forward, RBC's fill rates went up to 99.8%, meaning we never, ever, ever missed liquidity. We never missed what we saw. Now, if you work on the institutional buy side and you're a trader, you have brokers come in and see you night and day going, oh, we got the latest and greatest, fastest flux capacitor, heat map, and blah, 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 blah. And they just basically glaze over. And when I came in and said, yeah, we're going to do simultaneous arrival, they're kind of like, oh, what shit is this guy selling? But they started to use it. And RBC, all of a sudden, an unknown Canadian bank that ranked 19th as an electronic trading platform, we took on 450 new clients. And by the end of the first year, there's a survey in the US, it's called Greenwich Associates. They surveyed 2,200 buy-side firms. RBC went from a 19th rank to number 1 6 months after we launched this, and still 4 years later it ranks number 1 for execution quality. So the whole point of this is that instead of bitching and moaning about technologists getting ahead of us, because technically what they're doing is legal, the key tenet to what we did at RBC was fight technology with technology. The problem with that, I learned, is that people didn't really want to pay RBC. RBC is a great place to work, don't get me wrong, but in the US we're a smaller bank, and what I did not understand, not having come from Wall Street, is the way that people pay the banks like Goldman Sachs for IPO, for corporate access, is they pay them through trading with them. So no matter what we did, RBC plateaued. We couldn't do any more volume. So we came up with an idea. We were getting poached by other guys, and like if you read in the book, I did not know that he knew my salary, so that's a little embarrassing. But in any case, I made multiples of what I ever made in my life. And you know, Brad, who quit, was making $2 million a year. We were doing great. We took off, and we came up with an idea, and we said, listen, if we're plateaued here, why don't we just leave RBC and set up our own trading venue? And instead of people doing wrong, we can be the conduit for the institutional order to come to our market. So it was a little bit of a naive idea, and we got together with RBC's 15 largest clients in, and I'm going to answer your question, I promise. In I'm Irish. If you give me a beer, I'd talk for 2 hours. But we met in January 2012 with our 15 largest clients, and we presented this idea, and they asked us to leave the room at the time, and we came back in. They said, you can't do this under RBC. And I'm like, no shit. And they said, you're going to have to leave. So they basically talked us out of a job, and they said they would back us. Of the 15 firms, only one of them backed us. But we quit our jobs anyway, and we went on this campaign of every trading venue, except for NYSE and NASDAQ, are owned by broker-dealers or consortium of broker-dealers. So I wrote down what Hendrik said. It was a great decisions made for short-term gain. My industry is all about decisions made for short-term gain. It's ludicrous. So we said, the only way that this can work, the only way we can take out that conflict of interest is have this owned by the institutional buy side. So we went and we got this. I'm fast forwarding it because it was a pain in the ass to raise money. I've never done it before. But we're now owned by a consortium of 15 buy side firms. So hedge funds, mutual funds, and some family offices. We launched our trading venue in October. In any case, Lewis heard about us, and he heard about my technology background. There was a programmer from Goldman Sachs. His name is Sergey Lenikov. He's in the book. But what happened is he left Goldman Sachs, and he took a little bit of code with him, and Goldman had him arrested by the FBI, and he was sentenced to 8 years in prison. So Michael Lewis was writing a story on him last year in Vanity Fair, and he wanted someone who worked on that technology, which I did, to come in and explain to him what the hell Serg stole, that he got sent to prison and lost his wife and kids and everything. It's a pretty crazy story. He did get out after a year and a half, but I don't think I could last, an hour and a half in prison. But he he asked me what was he doing, and I just explained. I'm like, look, he technically stole something, but people take their contacts when they leave jobs. He never even had opened the file since he left his job. And then Lewis says, what are you guys doing? And he's so used to being pitched stories that we basically didn't even want to tell him. So he goes, I want some more background, and can I come by your office the next day? The next day he came by, and he ended up spending 5 hours with us. And the reason why I told you about these co-location centers is he said, look, I don't understand how the exchanges have turned into these 4 technology buildings in New Jersey. Can you take me out to see them? So I didn't tell the buildings who he was. I just set up an email address, michaellewis@iextrading.com, and only one of the 4 buildings asked him who he was. He just said media consultant. I was pretty happy. But I took him to these buildings, and when you go into these buildings, there's thousands and thousands and thousands of computers just humming. It's just like, doesn't look like trading, doesn't look exciting. And they're all in that building to have the lowest latency possible connectivity to those exchanges. So we went to the first building. He's like, this is cool. It's like space age and all the security. By the third building, which was NASDAQ, he's like, oh, Jesus, do we have to go to the 4th? And I'm like, you got to go to the 4th. The New York Stock Exchange moved their exchange from New York City in 2010, and they're out in a town called Mahwah, New Jersey. Mahwah, New Jersey is in northwest New Jersey. This is not like an industrial estate. It's kind of a strange place. It's very rural. I once called it the back ass of New Jersey to make a point, and the trader I was saying that to happened to live in Mahwah. So he still reminds me almost every time I see him that he lives in the back ass of New Jersey. But I was making a point that it wasn't a typical place to put a data center. Anyway, we take Michael to this data center because I wanted him to see it. Now, like I said, I've never gone to prison, but when you pull up to this facility, there's armed guards everywhere. They spent $600 million on this building. You pull in your car, something comes out of the ground to block you in, both forward and back. Guard dogs go through the back of your car, through your trunk, and everybody's armed. And you're like, Jesus, where am I going? You pull up to the building, it's like an airport screening again, and you go in. And even when you go inside the building, the tour guide we had a gun like strapped to his quad like Luke Skywalker. I'd never forget it as long as I live. I'm like, okay, I can understand the security getting in, but now that we're in here, do we need a gun to see computers? And Lewis was mesmerized by it, so we start walking down this cavernous hallway. This thing is about 4 football fields inside. It's like 460,000 square feet. And as we're walking down the hallway, the guy is regaling us with the power consumption, the heat, all this water suppression. And as he's doing that, Lewis puts his hand up like a kid. I'll never forget. He goes, excuse me, can you tell me how many security guards work in this building? And the guy goes, that's classified information, sir. So Lewis is, I guess a writer and a detective. About 20 seconds later, as we're going through the tour, Lewis puts up his hand again. You can see the guy going, yes, sir. And Lewis goes, how many people work in the building in total? 35, sir. And Lewis, without skipping a beat, goes, how many of them are not security? He goes, 29. Yeah. So I was there in the hallway, and should I laugh in this frickin' guy's face? Or should I just pretend he didn't just do that? So we got in the car after the tour, and I've done hundreds of these tours. I used to walk in these buildings. I said, I've never seen anyone undress security without them even knowing it. And he's kind of like, that's what I do. And by the way, I think there's a story in this. And we're like, holy shit, we just quit our jobs. The few of us who started were funding the company and paying for some people's salaries. And we're like, wow, Lewis is going to write about us in Vanity Fair. Anyway, it didn't turn out to be Vanity Fair. And if anybody read the book, I had no idea, honest to God, till a few days before the book came out, as to how much of the book we wore. We basically are probably 80% of the book. So, answer to your question, you ever hear your voice on an answering machine and you sound like a complete tool? Yeah, you all know what I'm talking about. Try and read about yourself. It's nuts. And I came down from reading my part. I came home and I'm like, one of the chapters is called Ronan's Problem. I ran upstairs and obviously my wife knew a book was coming. I go into the room and I'm like, I come down to the kitchen. She's literally walking around. She goes, how was it? And I go, he has me fucking cursing all over the place. And she goes, you just cursed again. And I'm like, shit. And she goes, you did again. You don't even know. So as I went through the book and I read the other characters in the book who I work with, I'm like, he nailed them. So he pretty much nailed me. But I'll say my cursing is not malicious. It's just words. Ireland, we curse a lot. So sorry. But in any case, the Lewis book, Lewis is out. He's an author, right? He's trying to sell books. I believe the vast majority of what he put in the book is 100% true. Sure, he made certain things a little bit more salacious than most. It's only like 270 pages. There's a lot more to equity market structure than 270 pages. But in any case, we built this trading venue. And the whole thing behind our trading venue is fairness, which it's great to be here today because usually I'm in front of traders. And traders, a lot of them on the broker-dealer, have been fleecing people for years, and they take great exception to be told to their face that they're fleecing people. So I'm not getting anything chucked at me right now, but you know, when the book went, I wasn't the most popular guy, but we've been doing lots of meetings. And anyway, what we did is we built out a trading venue, and we said, there's a problem with co-location. There's an inherent problem with a trading venue that should be a referee, just matching buyers and sellers, charge both sides of them. That's fine, but you should be a referee. And co-location, the ability to put your strategy right next to it and in millionths and billionths of a second find out what's going on and take advantage of other people's orders, it's wrong. So we set out to create a venue that the largest average trade size and the largest amount of 10,000 share plus prints. And that was our goal. Now that we're live, that's what's happening in reality. But how did we do it? How do we do it without getting people picked off? And this is not going to be too technical, but it's almost very simple.
I wish that we had time for an afternoon of stories.
Who's next?
Yeah, as a moderator,
Go
your
grab
biggest
a
fear
pint.
is you're going to sit down with someone and you just can't draw them out. So I apologize to everyone.
You put me in a shrink chair. I'm just.
But I don't know how much time we have. We're like the cane's going to come out and pull us by the necks at any second.
Just hold on.
But so just to bend all this toward the interests of the folks in the room, we are not high-frequency traders. We are, running pensions and foundation money, perhaps, and I don't even know, who's out there. But what are the benefits of solving this problem that you happened onto for everybody else?
Yeah, the benefits are truly for everybody else, because what it means now is when you as an institutional fund are trading, you're taking a position, whether you're buying or selling, you're getting the true price. As ironic as that sounds, you should get, buy side to buy side. If you're a buyer and one of you in the room is a seller, you should be able to meet on a trading venue. You shouldn't have an unnecessary intermediation of someone going, oh, I'm providing liquidity because I buy from him and sell to her in 1 millisecond. Guess what? If they weren't there, you're going to bang into each other and you're going to trade in a more fair manner. You're going to trade larger average trade sizes. That's what every institutional investor wants. We've done tests where we proved by trading one way versus another way, just on one trade, the trade implicitly cost you like $39,000, $40,000 more. Doesn't sound like a lot in the grand scheme of things, but when each and every trade, every time you press the button, you're only getting portions of what you see there, that ruins confidence in the market. So it's kind of ironic. Some people say that confidence in the market is waning because Michael Lewis wrote a book on it. I'd say if you asked 9 people on the street out there and said, is Wall Street, a little crooked, they'd be like, no shit it is, right? So for someone to say that Michael Lewis is ruining confidence on Wall Street because he's writing about a group of guys who, in my honest opinion, and I'm not just saying this in a room full of people, if you were in our office behind closed doors, we honest to God believe in what we're doing. And we went to like a fork in the road, and we could have gone down one way or we could have gone another way. And if you put a gun to my head a few years ago when I went on this journey and said, make money the fastest way for the next 12 months, I would have just gone back and run high-frequency strategies because it's very, very, very easy to pick off the likes of the institutional investors. You need representation out there. You do not have representation. Virtually, the brokers don't even hear from the exchanges anymore because their number one client are high-frequency trading. Not all high-frequency trading is bad, so I don't want people to misconstrue it. It's very hard to define exactly what it is, but there are predatory strategies that exist out there.
Well, on behalf of everyone, and as you might put it yourself, that was fucking awesome.
Nice.
Thank you.
Thanks. Appreciate it. Yeah. Thank you very much.